Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Hey guys, Adam here from BizNexus. I recently had a chance to sit down with Jim Bates from M&A advisory firm Jackim Woods based outside of Chicago, and we dove into what actually happens in the pre-transaction phase of adding value to the business as an M&A advisor working on behalf of a seller client in an ideal world. So Jim is somewhat of an exception here. He was actually the founder of the Exit Planning Institute and the certified exit planning designation that so many advisors out there have nowadays or are working towards. So he really does bring a deep understanding to this topic and to the discussion. And I think that with all of the newfound gurus popping up out there, crapping on the value of the M&A advisor and running retargeting ads to skip the broker, et cetera, this is an important and timely topic for owners weighing the pros and cons of whether they should be working with an advisor or not and what that actually entails. Transactions are unique, so obviously some deals might not need an advisory role, but in my experience, most do benefit if a qualified advisor plays a role somewhere in the process. Jim is part of our partner network, and he'll be back for more of this. So if you have any topics you'd like him to jump into for the next round, just DM us, and we'll try to make that happen. Disclaimer from the always present legal team: podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework. All right, Jim Bates, thanks for coming.
Hi there. Nice. Thanks for having me.
Yeah, absolutely. No, we appreciate you taking the time. So for those of you who haven't listened to the BizNexus Roundup, I'm Adam, the founder of BizNexus, and we speak with experts like Jim about very niche topics in M&A. And Jim is your partner of Jackim Woods and Sports Club Advisors, but you have over 25 years of experience specifically in exit planning, right? So Jim was a founder of the Exit Planning Institute and the certified exit planning advisor designation that goes along with that. You co-authored the Business Valuation for Dummies book, right?
That's right. Yeah.
Okay. Yeah. So you're in on that. Okay. So
kind of exit plan somewhere. Yeah.
Yeah. I think I actually do too somewhere. Exit Planning Institute, certified exit planning advisor designation, Business Valuation for Dummies. Right now, you're pretty much focusing on manufacturing through Jackim Woods and then fitness through your Sports Club Advisors, right?
Correct.
Okay. And your firm, I've got you down as having completed over 60 transactions, over 400 million in transactions. Your close rate is somewhere above 90%. Is that all about accurate?
Yeah, for 100% accurate.
All right, great. So I'm seeing your bona fides here because we wanted to get you in here to talk about what really goes on. Basically, what the hell is exit planning, right? You have a lot of brokers, M&A advisors who are out there, and I think you have a lot of owners, entrepreneurs, buyers, sellers who don't really know what that value add is that a broker specifically adds from the first moment of contact through, not the actual transaction, but just the listing, getting everything ready. So we wanted to talk with someone who has the type of experience that you do. So thank you again for coming out to talk about the topic and just get a firsthand experience of your experience and how you got into exit planning and have done everything that you've done since founding the Exit Planning Institute, the holistic philosophy that you have for exit planning, and just go through some case studies and the value prop, because I think it's so relevant. Right now we've got all these buyers who are talking about bypassing the broker. And I don't think that makes sense if you're talking about, working with brokers who are doing the type of process that you're doing, the lengthy process if you're working with a buyer or a seller. And then you have so many owners out there who just don't know what to do, right? I mean, they don't know how to take the first step. Maybe they don't know, maybe they're being penny wise, pound foolish from a cost standpoint. So they're not engaging with a broker early on enough. Yeah. So I'd love to hear your take on all of that. So why don't I shut up and you can just tell me a little bit about how you got into this with the Exit Planning Institute and just touch on just the holistic philosophy that you take to exit planning.
Yeah, I mean, I guess the first thing I'll mention that stood out of something you said is that buyers bypassing brokers. I have many buyers that hire me after I'm on the sell side opposite side from them,
Yeah.
but we'll get into that later. I guess really what you have to do is go back to the origin story of where all this came from, way pre-Exit Planning Institute. I got out of graduate school in the late 90s and I joined this boutique M&A firm. And in the recession in 2001, when, every recession, mergers and acquisitions activity is down, and we're all sitting around the conference room looking at each other going, what are we going to do while things are slow? And, we had a number of discussions over a couple of weeks where, we said, look, we've been really successful as business brokers. We've had a lot of successful exits. But in that post-exit interview, we've learned that our clients said, boy, I wish I would have understood more about valuation and deal structure and moving the different pieces around. And I didn't realize there was, a stock sale and an asset sale and sophisticated estate planning techniques that could minimize the taxes on the proceeds and different things like this. And so we started diving into this. We started having more discussions, which led to us really saying, somebody needs to develop a process, and part of this is because we're entrepreneurs too, right? We're trying to figure out how to innovate and how to survive in a recessionary period. But, in us trying to survive and figure out a way to bring revenue in, we said, boy, actually, this is the right way that everyone should go about doing this regardless, right? And it's, what do you do first? What do you do second? What do you do third? And what kind of a team do you need? And the exit planning coach is what fell out of that process and those discussions, which in essence, it was this 3-ring binder that had 14 chapters in it. And each chapter was kind of like the next step in the process, which culminated in the last 2 chapters of the book being custom timelined action plans. One was a personal action plan and one was a business action plan. So that's really how it all got started. It was kind of out of necessity or us trying to innovate to bring in revenue. And we kind of, I don't want to say fell into it, but we kind of fell into it, right? When we said, wow, this is actually the way that every privately held business owner should be approaching this. And that just led to the $10 trillion opportunity book and then led to EPI.
Yeah. I've got that one on my shelf too, by the way, the 10 trillion. Yeah. So it's in the wake of the 2001 recession, transactions aren't necessarily taking place. You got a lot of business owners out there that would benefit from an exit planning process. And so that's where you stepped in. That's where you innovated and created this whole process and founded what so many people are using today. People who are pursuing the Certified Exit Planning Advisor designation, everything with the Broker Simplification Act, where now you have accountants and consultants and everybody getting into the sell side transaction. So many people are engaging with this exit planning process. In the wake of that first crash, that's when this all came together. Owners just the transactions weren't happening. You thought you could add value to the owners in that environment and start coaching them back to health to get them to a position where they're exit ready.
Yeah. And the thing about it was again, we looked at it, we said, well, this is the right way they should do it anyway. And the proof was in the pudding, because the first couple clients that we took that did the very first exit planning coach process were phenomenal success stories. And then every single client after that was a phenomenal success story. And it just made sense because it was the right way to approach it. So why wouldn't every single one of them be success stories? So it just started growing and growing as we got the first exit planning coach client, and then the next one, and then the next one, and the rest is history.
But still, like I think in part we have you here because this is just such a blind spot for so many owners and honestly so many advisors who haven't engaged with the exit planning piece, right? They're just focused on the transaction piece. What if an owner thinks about they're getting ready for a sale and they're just thinking, well, I've got to have 3-5 years of profitability and maybe just avoid some customer concentration, then I'll be ready to go. Well, that's not what you're saying. You're saying that this is more of a holistic process. You're breaking this down between the personal side and the professional sides, the personal goals where you might need to loop in a financial advisor, an estate planner, or what have you, and then you've got everything going on with the business. Could you kind of dig in a little deeper as to what this exit planning coach is, what that holistic philosophy is? If an owner's engaging with you early, what's taking place, and those success stories, maybe hop into some specific examples of that
Well, I
value add.
mean, like you make a great point, right? So many people think it's just about addressing the business, right? Customer concentration issue or lack of depth of management, or, what are these factors that buyers are going to pick on? But the privately held business owners, when you go under, I don't know what the numbers are exactly, 50 million and under or something like that, or you look at roughly the percentage of privately held businesses in this country that are family owned, it's somewhere in the 10 to 15 million number, right? So you have 10 to 15 million businesses that are family owned. There's a lot more to that than just the business. So they've got personal financial, they've got family, they've got professional, and they've got the business. So the business is just one. We always say, like, they have these different worlds that are colliding. They have personal and professional, they have family. Don't forget, with these family-owned businesses, these key employees aren't family members, but they sure feel like family members. And sometimes they're closer to these guys than they are their family members. They spend so much time at this business. So maybe those guys aren't shareholders, but they're certainly stakeholders. So there's a lot of dynamics there, and these different worlds, family, personal, financial, business, these are all worlds that can have different value sets and or different goals and objectives. So how do you get those to be somewhat in balance or in equilibrium with each other? And that's part of going through this exit planning coach. I once had a contractor who said, boy, Jim, I really, we were talking, and he says, I need to maximize the business value for sale because I need to fund my retirement. I didn't do a great job in funding my retirement ahead of time. And then, just 5 minutes later in the conversation, he says, but, it's really important to me that my son, John, that I can, hand the business over to him. I said, hold on a second. Those two are in conflict with each other. We can't do a generational transfer and maximize, right? Or maybe there's some strategies and we can move some pieces around, but you have to understand that on the fundamental foundational level, those two things are in conflict with each other. So we have different worlds colliding outside of just the business, and that's part of going through this process.
Got it. And so, can you generalize when this process ideally should start? How much time does this take? Should it be a few years before the exit? Should it be, when should they first reach out to you?
Yeah, 6 months minimum. Ideally, the sweet spot should be 18 to 36 months. And really, again, what if we just work backwards? And a lot of people don't realize that in most deals, the buyer wants them to stick around. And there's a 6 month or a 12-month ownership transition period, which could be in the form, a lot of different forms. So do you count that when you say exit? When you say exit, do you mean completely gone, or do you mean exit just at the closing of the transaction? Because you may not be completely gone from the business at the closing of the sale. So depending on your perspective, you might need to budget that post-sale transition period into your overall timeline as well.
Yeah, and you're talking about 100% sale. They might also just wind up learning about their options for selling part of the business.
What if there's rollover equity,
right?
or even if it's 100% sale, maybe you stay on in an employment agreement or a consulting agreement, right? And if those can be 2 years. I have one client who's just finishing up a 2-year employment agreement.
Yeah.
So in that case, it's if you add 18 months of planning and 2 years post sale, you're looking at 3.5 years really from start to finish when you first dip your toe into the process.
Or if you're going with private equity group and you wind up rolling equity, you might be there for another 5-7 years in some form, because maybe your management team wants to stay on board with this new thing the private equity group is building. As part of that, you're lumped in, and you don't know those options until you go through them in the exit planning process.
That's right. And I think some of the latest statistics I've seen is that the median age of the family-owned business is 51. And, if they're second or third generation, that means they've probably been working in the business. They probably even started working part-time, maybe in high school, or in full-time right out of high school or right out of college, which means they've already been working for over 30 years, right? So how much longer do you want to work at age 51? We think, well, I'm going to work till I'm 65. That's where Medicare kicks in. Well, that's another 15 years. To your point, if it's a situation where they roll over equity and there's another 5 or 7 years in, then maybe 51 is the right time to start planning and thinking about things.
Yeah.
For sure, if it's 55 or over, definitely.
Or if they don't want to leave and they do something like that and they're able to get just added financial muscle and, added human capital and just more resources.
I mean, if they're younger and they're very entrepreneurial and growth oriented, but really, let's take it a step further and look at venture capital or private equity and how they analyze an opportunity. They're going to figure out their exit first and then work backwards. Part of the exit is a big component of their overall ROI in making the decision whether to bid or go after a company. So, even if you're young, or regardless of age, try and teach my clients or just educate the public in general that regardless of what business and what age you are and what stage the business is in, the exit plan is the foundation that the business plan lives on top of.
Yeah. And you mentioned off camera, off podcast, in another conversation that you can start these meetings really figuring out, well, what do you need? What's your magic number, right? How much money do you need so you won't run out? Maybe walk us through what typically happens in the first few meetings, right, with a new business owner. So an owner reaches out to you. You talked about starting with the end in mind. You're doing that with the business owners who you're speaking with through the exit planning process. Just kind of walk us through what that looks like for the first meeting and the first few meetings and what they should expect.
Yeah. So we go through a pretty extensive discovery process to really get to know them personally, as well as the business, because all of these businesses are unique and there's potentially unique owner situations. I've seen everything from, there's multi-generational and some folks have never worked in the business and other family members have, to, a business with 5 owners and each own 20% and they all hate each other. I mean, you name it, right? So every business is different. So you really have to take the time to get to know them personally and professionally, and as well as the business. And obviously when we talk about those different worlds colliding, when you look at the personal financial, retirement needs is, if not the biggest question that has to be answered, it's certainly in the top 2 or 3, which is that age-old question of trying to figure out, how much do I need in my nest egg or in my investment portfolio so that I can retire comfortably? Am I going to run out of money before I die? Or what I like to refer to sometimes is, will you end up living in your kid's basement?
And do most of them have a legitimate answer for you at that point, or it's just kind of like they throw out a magic number and then you need to bring in the financial advisor and the estate planner? Like, how does that typically?
Right. And so what I'm good at, is M&A, exit planning, valuation, and deal structure and things. And the whole idea of the exit planning coach is to also then, as you're getting to know them, learn what their existing team of trusted advisors looks like. So I'll ask when we start talking about the personal financial and, what their personal net worth statement looks like. Do they have a wealth manager? Who are they? What are their skills, experience level? What does their firm bring to the table? Do they offer sophisticated estate planning and things like that? And if they don't, you'd be surprised. Number one, you'd be surprised how many of them don't have a sophisticated wealth manager. And number two, maybe it's one where they have one and we don't want to fire anyone's advisor, but we might need to supplement the team. So what I'm good at is knowing what I am not an expert in and making sure that we do bring in an expert in that area and supplement the team and build that really strong team of trusted advisors around them.
So who's typically on that team?
A mergers and acquisitions attorney is on that team. A wealth manager is on that team. We're going to have to look at the accounting firm. If their accountant is someone who just primarily focuses on tax returns and things like that. And, we might want to do a pre-transaction quality of earnings type thing, right? Depends on the size of the deal and things like that. So, is the accounting firm have, those type, robust enough services where maybe sophisticated estate planning or Q of E type services are available? Tax and estate attorney, possibly commercial real estate attorney. That's why we spend that time in the discovery process to really, really get to know them.
And so, I mean, that's obviously a detailed process, a lengthy process. You're dealing with a busy CEO. I mean, how long should this, I mean, every business is different, right? But I mean, how long does that process take? Just really getting to know the business and them personally, and then being able to decide on, okay, this is the team we're going in with.
Yeah, I mean, that all falls out of the exit planning coach. And so again, as you said, it really just depends on the client. Are they with their schedule and what they're doing, and depending on, are they working in the business or are they working on the business? Some of the guys, the place would fall apart if they disappeared on vacation for a week, and other clients are snowbirds and go to Florida and they've built an infrastructure where the business is running on autopilot. So again, it depends, and it goes on a case by case basis. It's really just a matter of how fast the client can move. But if they're motivated, then it can be a 3 to 6 month, or at least 6 months is the most realistic. But if it's someone who's really busy with family and is heavily involved in the business and things like that, then we try and timeline it according to giving them bite-sized pieces that they can handle. Let's work on this step this month, or let's work on this step this quarter, and then we'll do the next step the next month or the next quarter, right? Versus trying to, so they're not overwhelmed all at once.
Yeah, and here you're still just really talking about the exit planning and the pre-transaction kind of process questions, right? Assembling the team and figuring out what the goals are. But you haven't even gotten into the value enhancement, which could take a lot of time depending on what you find. You mentioned to me again in another conversation, you shared a story about, I believe you shared this, and I can share it. If not, then we'll just have to cut this out. But it was a manufacturer who you gave them some advice on basically overhauling their manufacturing floor. I mean, can you go into that one or?
Yeah, a little bit. In essence, it was someone who came from a construction background and contracting type of world. But the current business that they were in, while it was building, it had more of a commodity type feature to it, where they were cranking out the same product over and over again. But their mindset was more of a construction or contract, project by project type basis. And our suggestion in doing our analysis was that they might want to look at redesigning the shop floor. And so we ended up helping them find an industrial engineer. I think the project cost around $70,000, but we were able to cut, and between productivity and efficiencies and everything else, close to $1 million in costs, which dropped straight to the EBITDA. In this case, it doubled their EBITDA, and on a straight 4 multiple, if you will, then that doubled the size of the company. I mean, in most cases, what that'll do is when you make these improvements, it won't just be the multiple will also increase, right? Because we're affecting growth, or we're affecting risk in the denominator of the valuation equation, not just the EBITDA that sits in the numerator.
Yeah.
So when you affect all of those, it also has an effect on the multiple as well. So $70,000, and there's $4 million return. When you do the calculation on that ROI, and someone will think that you've made an error, right? It's too good to be true. But those are the types of things that can happen.
You added $1 million back to that cash flow?
Correct.
Yeah. And I mean, $4 million, that you got a lot of buyers out there looking at like 6, 7, and private equity groups are really
all of a sudden the value
multiple like
4 to 8.
Yeah. I mean, that can be significant. And that all fell out of the exit planning process, right? Getting to know the person intimately, going through the check boxes, walking the floor. I mean, that's all an argument for the hands-on process, the exit planning process, where you're getting to know the owner, getting into the business, like literally walking the floor, and then coming up with, hey, you know what? Let's add someone else to the sell side team. It's going to be an engineer who can help redesign this floor, and we think it's going to add XYZ to the top line ultimately when you're selling.
Yeah, it's a matter of modeling those things out, and what we do is we score them. We score them for their relevancy as far as what their personal goals and objectives are, and then we score it also for the impact on value, because some things may not have a great impact on value that are going to double the the value of the business, but they are going to have an impact on saleability.
You're walking through that. It makes sense. And I know you have a market assessment. We'll get to that in the end. But just, I'm going to ask you to kind of go through that a little bit.
Yeah. So one of the steps in the exit planning coach is we have a 55 value factor checklist. Right. And we go through, and if it's something they do really well, it's a positive. If it's something that's fine, not really negative or positive, it's neutral. And then there are other things that, Rich Jackim and Pete Chrisman, who were my mentors at the Chrisman Group when we started Exit Planning Institute. Rich, you'll see Jackim and Jackim Woods Co. So Rich is my partner. Rich went to Kellogg, and at Kellogg, nothing is ever negative. It's only an opportunity for improvement. So we only call it an opportunity for an improvement. And so then in the next step, what we do is we take all those opportunities for improvement and score them. Which one's going to have the most impact? What's its score? Where does it fall on its impact to the saleability of the business? And what's its impact on the value? And then we can model those things out. Part of this is kind of an iterative, yes, it's a process, it's a planning process, but it becomes an iterative process. And what falls out of that is a decision-making tool. So we can look at it and say, okay, now let's score them for, which ones are bang for the buck. Which ones are easy to implement and are going to add value and saleability? Let's tackle that low-hanging fruit first. Other things could be like, oh, wow, you really have an e-commerce opportunity here. You don't do any e-commerce. What if, that's a little bit more intensive, labor-intensive, time-intensive, investment-intensive process. So then it goes back to those other worlds that are colliding. Where are you on your personal timeline? Where are you on your personal financial timeline? So does it make sense you can think about it as putting your house up for sale. If you've decided that you want to redo the powder room before you put your house for sale, you can either go to Home Depot and decide to do that yourself and do it a little bit on the weekends here and there, and it takes you a certain amount of time, or you can hire someone to come in and knock it out and redo the powder room. Or you can just put the house up for sale and not even bother with any home improvements.
Yeah.
Right? So it's kind of that type of a process. And we analyze those and model those out and score them. And then we have to make some decisions.
And how much are you, again, this is generalization, but like how much are you meeting with the CEO or the management team? If you're on site, you got to tell the employees something. Do they typically know that there's a transaction taking place, or are you, telling them that you're just a consulting team or a team of accountants? Or
well, the answer, the short answer to everything that you're ever going to ask me is going to be it depends. Right. Yeah. And that's why we take the time to get to know them, and every situation is different. So it depends on the situation as far as where they're at with their relationships with the employees and everything else, and how they've communicated with them over time. Sometimes it's a comfortable situation and we can be there and it's not going to cause disruptions. Other times, then we have to be highly or hypersensitive to any time that we spend on site and any conversations or involvement that we have with, key employees. So it just depends. And we deal with that as it comes, because each situation is different. We can do quite a bit these days virtually.
Yeah.
And before we get key employees involved. And I think that there's a message too. Especially with the older, I tend to have a lot of clients that are 65 and over, and employees have to know that none of us live forever. Or one of my favorite singers says, nobody gets off this planet alive. So, at some point when you have an owner who's 70 or an owner who's 75, keeping the employees in the dark is actually worse than communicating with them. Yeah. And there's a timing and there's a message. And I think once they know, oh, wow, this guy's going through, this guy really cares, this person really cares, they're taking the time to do this pre-transaction because they want to make sure that the company goes on. And now I feel better, because before I went to work every day knowing, gosh, this guy's 75. I wonder if he has a plan. Well, now they know he has a plan. So, I think that can be dealt with as long as you approach it in the right way and communicate in the right way.
And so for the owners out there who are listening to this and who are nervous about their employees finding out or competition finding out, there are 1,000 different ways to frame this, whether you're looking to assess optionality or you're looking to get a capitalization in place, or you're just bringing a team of consultants to make sure that your valuation is where it needs to be, or blah, blah, blah. They shouldn't postpone reaching out on the exit planning process because they're nervous about this piece.
No. That's a self-inflicted error.
Yeah.
If that's what's driving if that's the main driver that's keeping them from taking action.
Yeah. But when we came up with this whole idea, you told me about how many owners are doing, that self-inflicting harm by not reaching out or not knowing when to reach out and waiting too late.
Yeah, it's really the biggest frustration that I have is not getting to have these conversations, 6 months or longer before someone is ready to pull the trigger and put their business on the market, because I can do more, they can do more, and they have more options available to them versus waiting for some kind of triggering event, an illness, God forbid, of themselves or a family member, or burnout or market forces or whatever it is. And then some of the options are taken off the table. Right. Yeah. Because it's just, okay, we're in the market, and yes, we would have liked to have done that, but we didn't start early enough. But we still have to sell the business. So we're selling the business, and this is what it is.
Yeah. And even if it's not like a divorce or health reasons, you've been at this for over 25 years, you're going to know what potential buyers on a company are probably going to beat up an owner for and try to use as leverage. The sooner you can reach out to someone like Jim, the better, right? Because if you have a short runway, you're not going to be able to make a difference on a lot of those line items. But if you meet earlier, then yeah.
I've got another client who's my age, and he made the mistake of, I don't say a mistake, but here's another reason why even just having some of the basics covered, he got approached by a competitor out of the blue who wanted to buy him. Because how can we do this? It's like, well, we're going to write a pretty comprehensive investment memo to give them all the information they need to evaluate the opportunity. It's going to take us a couple of months at least. So now, while we've got, somebody who is really, hot to trot, we've got a buyer on the hook we didn't even know didn't even know, but it's a major strategic buyer, and they really want to buy us. You don't have anything ready.
Yeah. They have no advisor in place.
They have no advisor in place, but it's more than that, because there could be a bunch of control adjustments on the P&L. There could be things with inventory. There could be a lot of things, where it's kind of like mini forensic accounting type projects that have to take place to put the schedules together to adequately communicate, an investment memo type level detail that a buyer would require.
Yeah.
Meanwhile, now they've got an interested party, and they're on hold for a couple of months while we scramble to put together a package.
Yeah, just defensive, not where you want to be. So, so far in this conversation, we've touched on a few different exit scenarios for that owner, right? We talked about the 100% buyout right off the bat, and then talked about private equity, and are you going to roll some equity and then potentially stay on 5-7 years and be part of growing this big thing where you could get a second transaction potentially down the road. Now we're talking about a competitor out of the blue approaching you and a corporate acquirer. What other exit paths are there? I know you mentioned 7 exit paths. Can you just touch on those?
Yeah, there's kind of a classic slide in corporate finance or M&A or whatever. I think it's Robert Slee is the guy who originally came up with it, right? It says there's only 7 ways to transfer a business. One of those 7 ways being IPO, which isn't going to apply to almost all smaller family-owned or privately held businesses. So there's really only 6, and a couple of them are internal, a couple of them are external, and so that's part of the process of that exit planning coach, or taking that holistic view of it, that we really have to have a sense of what the personal and family goals and objectives are, and goals and objectives, right? Because does it make sense for generational transfer? Earlier in our conversation, I told you about the client who needed to maximize value to fund his retirement and also wanted to gift it to his son, right? Yeah. So maybe there's a strategy where you can do a recap of the company and create trusts with voting shares and non-voting shares. And so maybe step one is an internal transfer that's part of a sophisticated estate planning thing. And then at later date, it's a sale on the open market, or it's a sale with some rollover equity once it's been handed off to his son, right? Yeah. Or is it an internal transfer to key management or an ESOP? Or is it a sale on the open market? All of these have different valuations. And so that's part of when we look at, we have our value factor analysis where we go through the 55 value factors and score them. But then we have to go through the six transfer channels and go, okay, given what you've telling us is your personal, professional, and business goals, which of the transfer channels are applicable? And then take all the ones that are applicable and then again, model it and do the math. And then it comes back, okay, here's the decision-making process.
Right.
It's all connected.
Yeah. And I think you probably get a lot of owners who are really just focused on that valuation number, but they really haven't dug deep into, payout schedule and contingencies and everything else that goes into, what offer you're looking for, right? Depending on your time.
Right. And it could be that, maybe an ESOP is a fallback strategy. Yeah. We're going to go to the market and try and get a premium to a strategic buyer. But if we can't do that, then, oh my gosh, are we stuck? Because of this and that and the other, we're really not set up as an attractive target, as a new platform for a private equity group. So we've tried to go to some to be an add-on if they have existing portfolio companies and maybe some of the strategics also. But you know what, we weren't able to find a buyer. So are they just stuck? Are they stuck with this business until they die? Well, no, maybe ESOP then is the second wave or the second fallback strategy, if you will, once the search or attempt to find a strategic buyer doesn't work.
Yeah. There's so many options. And so, there's a reason why people spend as much time as they do studying for the Certified Exit Planning Advisor designation. And going down that rabbit hole of optionality, right, for owners. Your free market assessment does kind of sum this up, right? So if there's an owner out there listening to this and they're starting to just kind of go a little bleary-eyed from listening to the options and they want to know what's appropriate for them, we'll put that link in the show notes, but briefly, if you just touch on it again, like what should they expect? They want to reach out to you and contact you directly, or if they want to go through and just take that market assessment, what does that look like? How long will it take them and what's it going to cover?
Yeah. So for the most part, the market assessment is a discovery process that we go through, which is really the first step is getting an idea of what the business is worth. So in essence, we'll model out, we might model out more than one or two scenarios in some cases, but just getting a ballpark or range of values of typical deal structures and what we see from getting to know them. So really involves a couple of long conversations, maybe 1 or 2 hour phone calls or, video calls, and then a collection of the relevant financial information, enough relevant financial information that we can make a relatively sophisticated valuation. Right? It can be more of a 30,000 foot view. And then once they become a client, we can get much more granular with the inputs into the valuation. But at least in the initial stage, in that discovery phase, it's nice to have a rough idea of where we see the transaction falling in order to see how it meshes with their personal goals and objectives and financial retirement needs and things like that. And so it's really just a discovery process. So it's a couple of lengthy discussions to really take the time to get to know them personally and as well as their business. And then, however much time it takes us to get a valuation model put together. Really how long that takes is dependent on the client. How fast can they get us information and how responsive are they when maybe we request a few other things or have some other questions. It's all different levels of sophistication. So sometimes we ask a question, it's like, I got to call my accountant, I'll get back to you, and 2 weeks go by. And other times we ask a question and we've got they generate reports and we have them by the end of the day. So how fast we move and how long things take is dependent on our clients usually.
Case by case. Yeah, but I
Yeah.
think, I mean, this conversation hopefully shed light on what goes into the lead up for a middle market transaction, certainly, but a lot of these people out there who might think that hiring a broker is just, they put together a sim and then blast it out to 500 of their closest friends. Well, no, I mean, especially if you haven't gone through your goals. Do you want to pass this down to family? Do you want to, have the highest possible valuation? There's a lot that goes into it, and this process can take years. If they want to reach out to you directly, what contact info are you comfortable sharing?
Yeah, I mean, look, they can they can find my mobile phone and my email address right on the website. Are both the JackimWoods.com and SportsClubAdvisors.net are very comprehensive websites. Give quite a lot of detail on the different services. There's links to both of our books. There's great blog articles. I would just say go to the website. You can find contact information and much, much more on the website.
Yeah, those are great books. Business Valuation for Dummies, $10 trillion opportunity. Both great reads, highly recommend. We'll put your LinkedIn in the comments. We'll put in the market assessment and the link to Jackim as well. Anything else before we close out that you'd want us to share?
No, I just, I mean, my biggest thing is have those conversations. Don't be scared to have those conversations. Too many times the business owner doesn't really know who to talk to, right? And there's a little bit of trust and cost issues going on, right? Because there's a lot of business brokers, like you said, they just want to put a sim together as fast as possible and share it with 500 of their friends and get a success fee at closing. And so there has been a lot of that in the past, and they don't know who to trust. And sometimes they're hesitant to talk to their attorney or talk to their accountant because they think, oh, well, if my attorney picks up the phone, I get a bill in the mail.
Yeah.
Right. And they're not going to talk to these things with their buddies at the club or when they're going golfing or whatever, and their buddy says, oh, I sold my business for 10 times. Or it's like, well, did he really? Or is he kind of embellishing? And so they don't know who to talk to. They don't know where to start. And it becomes this, what I call a right-hand drawer project. And so I think the biggest thing is just start having conversations and it's a process, right? It's a marathon, not a sprint. So the earlier you start the process, the better.
Yeah, and the earlier you know your options, right, and what your goals are. So, all right. Well, Jim, thanks again for taking the time to show up. We're definitely going to ask you back if you don't mind.
This was great. Thank you so much.
Absolutely. And again, I think it's rare that we have somebody with the exit planning experience that you have in terms of just really being one of the founding fathers here of this industry. So for the whole lead up to the transaction, we're probably going to ask you back for that piece again. Just be forewarned. But for now, we'll leave it at that and really appreciate you taking the time.
Yeah, we didn't even talk about valuation.
I know. We'll have to do that for another one because there's the exit planning questions. There's the pre-transaction process questions, which we went through. But in terms of valuation and the value enhancement, we really didn't even dig into that deeply. So maybe that's what we do for the second round.
Yeah, let's do it.
All right. Appreciate it, Jim. Thanks for coming.
Okay, thanks so much.